Before you buy that next big thing stock in 2026, pause for 10 seconds. Not to check the chart, not to check the comments, not to check what the loudest voice online said. I want you to check 3 receipts, because in a noisy market, hype doesn't beat you by being louder. It beats you by getting you to pay full price for a story before the story has earned it. By the end of this video, you'll have 3 simple tests straight out of Benjamin Graham's way of thinking that'll let you spot hype traps fast, even if you're not a professional analyst. You won't need a complicated model. You won't need to predict interest rates. You won't need to be early. You'll just stop buying dreams at retail. Picture this. It's late. You've done everything responsible. Money goes into your 401k or your IRA. You're trying to build a real retirement plan while life keeps charging subscription fees, groceries, rent or mortgage, health insurance, kids, parents, car repairs that show up like surprise bills from the universe. And then your phone lights up with a headline, "This company is the future. The price is running." The chart looks like a staircase. Someone posts a screenshot of options profits. Another person says, "Wall Street doesn't get it yet." The theme is everywhere. AI stocks, the next platform, the next picks and shovels, the next breakthrough. Your thumb hovers over buy. That moment is where long-term investors get hurt. Not because they're dumb, because they're human. And the market knows exactly how to speak to humans. Graham's most underrated lesson is that the market is not your teacher. It's your business partner. Every day, Mr. Market shows up with a price. Sometimes he's calm. Sometimes he's euphoric. Sometimes he's depressed. Your job isn't to match his mood. Your job is to decide whether his price makes sense. A hype trap is what happens when Mr. Market shows up in a costume and tries to sell you confidence at a premium. And here's the part most people miss. Hype traps don't require fraud. They don't require bad products. They don't even require bad companies. They just require expectations that are too expensive. The pattern is old. The costumes change. In the late 1990s, it was eyeballs and new economy. In other cycles, it was housing and prices never go down. More recently, it's been meme stock mania, zero commission dopamine, and themes that spread faster than fundamentals. In 2026, the stories have new vocabulary. Chips, models, automation platforms, but the human wiring is the same. So here are your 3 receipts. Keep them in your head like a small checklist you can run in under 5 minutes. Receipt 1, the numbers receipt. Is this a business yet, or mostly a narrative? Receipt 2, the price tag receipt. Even if it's a good business, are you paying for perfection? Receipt 3, the survival receipt. Can it survive a bad year without diluting you into dust? If a stock fails even one, you don't have to debate it. You just classify it correctly. Investment or speculation. And that distinction is everything in Graham's world. Graham's definition is practical. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Notice what's missing: excitement, hot themes, being early, bragging rights. Graham didn't say speculation is evil. He said it becomes dangerous when you don't know you're doing it, when you dress it up as investing because the story feels sophisticated. In 2026, stories are especially seductive. AI plays, disruptors, crypto-adjacent narratives, options trading clips, ETF flows, chasing whatever just worked, and underneath it all, the same ancient human software. Fear of missing out, envy, impatience, the need to feel certain. Graham offers a different kind of certainty. Process. Let's run receipt number 1, the numbers receipt. Here's the simplest way to say it. Hype loves accounting. Reality loves cash. A hype trap can show you profits on a slide deck while quietly draining cash in the background. It can show adjusted numbers that get adjusted every quarter. It can show revenue growth that doesn't translate into money that actually stays in the business. So your first question is not, is revenue growing? Your first question is this business producing real free cash flow without financial gymnastics? You don't need to memorize formulas. You just need to look for a pattern. And it shows up in 3 signs. Sign 1. The company is always 1 year away from free cash flow. You'll hear, we're investing for growth. We're scaling. Margins will expand. Maybe they will. But if it's been years of the same promise, that's not an investment thesis. That's a waiting room. Sign 2. The company has a second set of earnings. If you see press releases celebrating adjusted EBITDA, while the actual earnings and cash flow lag behind, slow down. Adjustments aren't automatically wrong. Graham understood non-recurring items. But when the adjustments become the business model, the numbers receipt is telling you the truth. The story needs makeup. Sign 3. The progress disappears when you switch from company level to per share. Hype loves headline growth. Revenue up 40%. Users up 60%. Bookings up 50%. But if the share count is climbing and climbing, your slice of the pie isn't growing the way the headline suggests. You can win the story and still lose the investment because you got diluted. And here's a quick mental trick that saves time. Follow the cash trail. If operating cash flow is weak, ask where the money went. Did it go into working capital because customers aren't paying quickly? Did it go into capital expenditures just to keep the lights on? Did it go into acquisitions that keep resetting the growth story? Did it go into stock-based compensation that looks non-cash but becomes dilution later? None of those automatically disqualify a company. They just tell you whether you're looking at an engine or a treadmill. This is where Graham's checklist mindset is priceless. He cared about financial statements because they are the only part of the story that has legal consequence. A practical move you can do tonight. Open the annual report and search for 2 phrases: cash provided by operating activities and share-based compensation. You're not trying to become an accountant. You're trying to see whether the business is paying its own bills or borrowing confidence from the market. If operating cash flow is consistently weak, while share-based compensation is consistently strong, what's happening is simple. The company is paying people because of you. The hype is being funded by dilution. Now, let me make receipt number 1 even more usable. If you can only ask 3 questions, make them these. 1. Over the last few years, is free cash flow mostly positive? 2. Do the earnings look cleaner in the filing than they look in the marketing? 3. Is the business improving per share, not just in headlines? If you can't answer those with confidence, don't pretend you have an investment. You have a narrative you're renting. And here's the uncomfortable truth. A company can pass receipt number 1 and still be a hype trap. Because the next trap is where even smart people get caught. Receipt number 2, the price tag receipt. Graham's most practical sentence might be this: price is what you pay. Value is what you get. A wonderful business can be a terrible investment at the wrong price. And a mediocre business can be a good investment at the right price. This is the part modern markets try to erase because it ruins the party. In 2026, parties are everywhere. The algorithm rewards excitement. The news cycle rewards certainty. People want one stock to fix their future, and the market happily sells you that fantasy at a price that assumes the fantasy must come true. So here's the price tag test in plain English. If you need perfection to justify the price, you're not buying a business, you're buying a miracle. How do you detect perfection pricing without building a 20-tab spreadsheet? Use a Graham-style sanity check. Simple, conservative, and fast. First, normalize the earnings. Not the best year, not the worst year. A realistic earning power. If the company is cyclical, you don't value it at peak margins. If it's early stage, you don't value it as if it has already matured. Many defensive investors use a multi-year average as a reality anchor because it stops you from falling in love with the best possible version of the story. Second, ask what return the price implies. At a simple level, if a stock trades at 50 times normalized earnings, your starting earnings yield is about 2%. That number is not a prophecy. It's a starting point. It's what you're paying for today's earning power before you assume any growth. Now compare that implied return to alternatives you can actually own today. High-quality bonds, treasury bills, money market funds, broad index ETFs. You don't have to predict the Fed to compare opportunity cost. In Graham's era, he constantly weighed bonds versus common stocks because the competition for your capital matters. When safe yields are meaningful, the margin of safety bar for stocks goes up. When safe yields are tiny, the bar can be lower. But the principle never changes. You demand compensation for risk. The hype trap shows up when people stop demanding compensation and start demanding excitement. Here's a perfection math example you can do in your head, step by step. Say a company earns $1 per share today, normalized. If you pay $50 for it, that's 50 times earnings. Now imagine the company does something impressive. Earnings double to $2 per share. If the market still pays 50 times, the price could be 50 times $2, which is $100. Great, but hype traps happen when the multiple compresses, when the market stops paying for the dream and starts paying for the reality. So, if earnings double to $2, but the multiple falls from 50 to 25, the price becomes 25 times $2, which is $50. That's the same $50 you paid. You got a 100% earnings increase and a 0% price return because you started at a price that already assumed the future. That is the silent danger of great company, any price. This is why Graham insisted on margin of safety. It's not just protection against being wrong about the company. It's protection against being wrong about the crowd. Because hype traps are often not fragile businesses, they're fragile expectations. So do this simple smell test. Ask if the company hits merely good results, not legendary results, what happens to this price? If the honest answer is the stock gets cut in half, you've learned something, not about the company, about the price. Now take a breath, because there's a third receipt that matters even more when markets swing between euphoria and fear. Receipt number 3, the survival and dilution receipt. You can have real numbers. You can even have a price that looks reasonable and still get wrecked if the company cannot finance itself safely through an ugly year. Graham's defensive investor cared deeply about financial strength because markets don't just change opinions, they change access to capital. When conditions tighten, the companies with weak balance sheets don't get a gentle slowdown. They get cornered. And cornered companies do two things that hurt shareholders. They raise expensive debt, or they issue cheap equity. Either way, your future return gets handed to someone else. So how do you spot survival risk quickly? Start with one brutally simple question. Does this company need friendly markets to survive? If the answer is yes, you've found a hype trap candidate, because hype loves companies that require constant applause. Now look for 3 red flags. Red flag 1, heavy debt with near-term maturities. You don't need to map every bond. Just notice whether the company talks a lot about refinancing and whether interest expense is rising. If a business must roll debt over soon, it's vulnerable to whatever rates and credit spreads decide to do, whether rate cuts come or not. Red flag 2, weak interest coverage. If operating income barely covers interest payments, the company has less control over its destiny than the story suggests. A single stumble, a single demand slowdown, a single cost shock, and the balance sheet starts making decisions for you. Red flag 3, dilution disguised as compensation. This is the 2026 version of a silent tax. Share-based compensation can be fine in moderation, but when it becomes massive, it turns shareholders into the funding source. The business can look cash flow positive while quietly increasing the share count and shrinking your ownership. This is why per share thinking is not a technical detail. It's moral clarity. You didn't invest in a company, you invested in your portion of a company. And if your portion is constantly being sliced thinner, the hype trap can persist for years without collapsing, while your returns get eaten. Graham's quality screens were designed to avoid exactly this. Companies that look exciting but lack the financial strength to protect the common shareholder when the cycle turns. Here's a tiny practical move. Pull up a 5-year chart of shares outstanding, not the stock price, the share count. If it's rising steadily, you need to demand a reason that benefits you, not management. Now, let's tie the 3 receipts together into something you can actually use, especially if you're building retirement wealth, starting late, starting small, or just trying to stop feeling whiplash every time the market gets loud. And if you want a Graham checklist shortcut for receipt number 3, here's a defensive version that fits on a sticky note. You're looking for a balance sheet that isn't begging for mercy, and a history that isn't 1 good year plus 9 excuses. So ask, does it have enough current assets to comfortably cover current liabilities? Is long-term debt modest relative to the business's earning power? Has it shown earnings stability across a full cycle, not just during a boom? And if it pays a dividend, has it maintained it through stress? These aren't glamorous questions. That's the point. Hype traps hate boring questions because boring questions end the conversation. One more modern trap to watch: fees and friction dressed up as strategy. If you're constantly trading in and out of story stocks, paying spreads, chasing alerts, or leaning on options because it feels like you're doing something, you're quietly donating your edge. Graham's approach is the opposite. Low friction, low fees, high patience. Whether that's a simple allocation with broad, low-cost ETFs or a small number of carefully chosen value investing positions, the goal is the same. Keep more of your return and reduce the number of ways you can sabotage yourself. And here's the twist. The same 3 receipts that protect you from hype in bull markets also guide you through crashes. When volatility spikes and headlines turn dark, Mr. Market flips from pay any price to sell at any price. In those moments, the investor with receipts can do what the crowd can't: separate fear from value, strong cash flow, strong balance sheet, and a price with a real margin of safety. Those are the rare times a defensive investor can buy without needing optimism, because the math does the calming for you. That's how you get rich slowly. Fewer bets, better prices, and more time working for you. Here's the rule. If a stock fails any one receipt, you don't have to ban it from your universe forever. You just relabel it. If it fails the numbers receipt, it's a story stock. If it fails the price tag receipt, it's a great company at a dangerous price. If it fails the survival receipt, it's a shareholder risk, no matter how good the product is. And once you label it honestly, you choose behavior that matches the label. This is the difference between a defensive investor and a hopeful investor. A hopeful investor asks, what if it works? A defensive investor asks, what if I'm wrong? That question is not pessimism, it's risk management. Now, a quick reality check. This channel is educational, not personal financial advice. The point is to upgrade your decision process so you're less vulnerable to the market's moods. So here's a 90-second routine you can run before you buy anything you feel excited about. Step 1. Numbers. Is free cash flow real? Are the earnings clean? Is per share progress real? Step 2. Price. Does the valuation assume perfection? What return does the price imply? Where is my margin of safety? Step 3. Survival. How strong is the balance sheet? Is refinancing a hidden risk? Am I being diluted? If you do only that, you will dodge most hype traps automatically. Not because you predicted the future, but because you refused to overpay for uncertainty. Now let me add one piece that can save you a painful year. What if you already own something that might be a hype trap? Don't panic sell because a video scared you. Do something smarter. Write down the thesis as a paragraph. What did you believe would happen? What evidence would prove you right? What evidence would prove you wrong? And most importantly, what price did you pay? And what kind of future does that price require? This is Graham's discipline in modern clothing. When you write it down, you remove the fog. You stop letting the chart rewrite your memory. Then you make a decision that's defensive, not dramatic. If it fails the numbers receipt, you treat it as speculation. Small size, controlled risk, no retirement money. If it fails the price tag receipt, you ask whether you have margin of safety. If you don't, you consider trimming, not because the company is bad, but because the price made you fragile. If it fails the survival receipt, you take it seriously. Balance sheet risk is not a personality trait, it's math. And this is where Graham gets even more powerful, because he wasn't just teaching stock selection, he was teaching temperament. Most investors don't lose money because they can't calculate intrinsic value. They lose money because their process collapses under emotion. Mr. Market doesn't beat you with math. He beats you with mood. That's why the boring edge matters. Bonds, cash, allocation, rebalancing. If your entire portfolio is built to win big, you're forced to participate in hype to keep up with your own expectation. And that is a fragile way to build a retirement. A defensive investor builds a portfolio that can survive embarrassment. It can survive missing a rally. It can survive a bad year. It can survive the temptation to use leverage or chase short-dated option because someone on your feed did it. Because here's the retirement truth nobody makes into a viral clip. Big drawdowns are not just painful, they're mathematically expensive. If a portfolio drops 50%, it needs a 100% gain to get back to even. And if you're near retirement, sequence of returns risk means a big early loss can permanently change the life you can afford, even if markets recover later. Graham wrote for real people who had jobs, families, and limited time. The defensive investor approach is not about winning arguments online. It's about getting to retirement with your dignity intact. And yes, you can still own individual stocks, but in Graham's framework, you earn that privilege by requiring margin of safety and financial strength. You don't buy because the theme is hot. You buy because the numbers, the price, and the balance sheet all agree. If you're wondering where this fits with asset allocation, think of it this way. Your stock selection is the what? Your allocation is the how much your emotions can tolerate. Plenty of investors blow up not because they picked the worst stock on earth, but because they put too much into one idea at one price, in one mood. Graham's defensive investor often held a meaningful bond or cash allocation because stability is not a drag, it's a tool. It lets you rebalance instead of panic. It lets you act when others can't. Now let's go back to that moment. Your thumb over the buy button. In that moment, your brain is not asking, what is intrinsic value? Your brain is asking, will I regret missing this? Mr. Market whispering. He's not offering you value. He's offering you relief from anxiety at a premium. So you do the opposite of what hype wants. You slow down. You pull out the 3 receipts and you make the decision boring. Numbers, cash flow over captions, price, value over vibes, survival, strength over storytelling. Sometimes you'll run the receipts and the stock will pass, and you'll buy calmly with position size that matches your risk, and you'll sleep. Other times, it won't pass. And here's the real victory. You won't feel left behind because you'll understand what you just avoided. You avoided paying full price for a future that wasn't guaranteed. You avoided becoming the liquidity for someone else's exit. You avoided turning your retirement plan into a mood swing. In 2026, the edge isn't being early. The edge is being selective. It's insisting on the old-fashioned idea that investing is about what you can reasonably prove, not what you can loudly imagine. Mr. Market will be back tomorrow with another price and another story. He always is. You don't have to fight him. You don't have to impress him. You don't have to keep up with him. You just have to remember, an intelligent investor is not the person who predicts the hottest stock. An intelligent investor is the person who refuses to be rushed into overpaying. Run the receipts and let the hype go. Find someone else's thumb. This is Benjamin Graham Investing. Stay disciplined, stay defensive,